Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. And before we jump in today's episode, which I reckon is a pretty good one, if I may say so myself, I just wanted to remind people, if you're interested in buying a copy of my book, Investopoly, even to pass on as a gift perhaps, you can do so for $20, no postage. The link and the discount code is in the show notes, so feel free to avail yourself of that. Okay, so let's get in today's episode then. All property investors, if you are an existing property investor, you would be well aware that costs have risen substantially, particularly over the last 4 years. Not only has the cash rate jumped from 0.1% to 4.35, so it's a substantial increase, inflation has impacted, investment property holding costs as well. And whilst inflation might ease, so that is the rate of growth in these expenses might ease, the expenses themselves aren't going to go back down to pre-2020 levels, of course. This higher level of holding costs is here to stay. And so that realization invited me to really question, what impact is that going to have on investment returns? Does that mean that investing in property is no longer, as lucrative as it used to be? And what higher growth rate do we need in order to offset those higher expenses? And that's what I started with. They're the questions I started with, and that's what I'd like to explore today. So I have prepared a chart that sort of sets out the changes in holding cost components, over the last 4 years. So really beginning of 2020, if you like, so kind of pre-COVID, to sort of encompass that last sort of 4-year period. Interest rates have increased by 58%. Land tax, using $1 million in Victoria, for instance, has increased 56%. Land tax has probably increased more than that for most people, because not only have the rates risen in Victoria, but the land values rise from year to year as well, and sometimes push you into the next tax bracket. That's true for all states, including Victoria. Council rate, they've risen. I just looked at a couple of my properties, about 30% over the last 4 years. That's sort of anecdotal evidence, of course, but, I think most people are experiencing a rise in council rates. Insurance, well, if you look at the ABS figures that are part of CPI, insurance is up about 20%, which seems consistent with my experience as well. And just general CPI over the last 4 years is up almost 17%. So that's all the bad news, obviously substantially rising costs. We all know that rental incomes have risen as well. Rental incomes across Australia as a sort of aggregate figure are up 32.5%. So we have had a rise in income, but there's a lot of costs that have risen a lot more than what rental has, interest being one of them. And interest typically is about sort of 80-90% of running costs associated with holding investment property, assuming that it's a highly geared investment property. Now, in the past, when I've done numbers regarding financial modelling or analysing an investment property acquisition, those sorts of things, I've kind of assumed that the holding costs excluding interest will equate to about 25 to 30% of gross rental income. Now, that's true for most properties. There's going to be some exceptions. For example, if it's an apartment with very high body corporate fees, or, a property with a lot of amenities or so forth, you might adjust that assumption. But sort of 25-30% is about right for most investment properties. But when you have a look at the data over the last 4 years and the change in expenses, I think that range now needs to be extended to really 30 to 35%. So that is, if you're going to prepare some projections or make some assumptions around cash flow, you've really got to assume, let's be conservative, let's say 35% of gross rental income will cover things like property management and maintenance and insurance and council rates and water and those sorts of running costs, everything else except interest. Now, as I said, the interest rate compared to the start of 2020 today is almost 60% higher than what it was back then. So it's been a bit of a shock, I guess, in terms of interest holding costs. But if we look at the average rate over the past 20 years, according to the RBA, the average rate for investors is around 6% over that period of time. Now, at the moment, investors are paying somewhere between 6.5% and 7%. So we're certainly above that sort of average rate, maybe up to 1% above that average rate. But again, if we're going to do some long-term projections and analysis of, is it worthwhile to invest in property? I think we need to assume the interest rate's going to be in the range of 6 6 to 7%, just to be conservative. As I said, the average is 6 there. Don't necessarily want to just take that average. Maybe 6.5% might be a good long-term assumption with respect to interest rates. And that's what I've used in this analysis. Now, in terms of income, I think every person in Australia, every commentator in Australia expects rental incomes to continue to rise over the next couple of years at a much faster pace than they have previously. So, above average, if you like. That's going to be driven really by the laws of supply and demand. There just aren't enough rental properties around. We're not building enough new properties. There is a shortage of rental supply, and that will translate to higher prices. And if rental yields revert to the mean, which I'm sure they will, it means rent probably will rise another 20 to 25% over the next couple of years, but eventually they'll level out. And the long-term growth rate in rentals since 1980 is about 3.8%. So they do grow at a faster rate than inflation, which kind of makes sense because obviously the value of the asset is growing by more than inflation as well, and investors demand a return on that. So I think we'll see a rise in rents, but then they'll start to level out 4-ish% in terms of annual growth in the long run. So anyone that's been listening to this blog for any period of time will know that I love to get into the numbers and look at the evidence and do the calculations. I mean, as a background as an accountant, that you can never sort of resist that temptation. As much as people sort of make fun of me with all those spreadsheets, particularly my two sons, it is something that I enjoy nonetheless. And so what I wanted to do is let's pick the starting point. Let's assume that expenses are 25% of gross rental income, which is really what they were, as I said, pre-2020. And I use some other assumptions like a starting yield of 2.7%. I'm going to assume that rent grows by 10% per annum for the next couple of years and then stabilizes at the long-term growth rate of 3.8. Let's assume the capital growth rate is 7% long term. Let's go with a 5.5% interest rate. And as I said, expense is about 25% of gross rental income. Let's assume we buy the property today, we hold it for 20 years, then we sell it. We repay the loan, we have to pay for selling costs, and then we'll pay for CGT, of course, and we'll walk away with a bunch of cash. I worked out that the internal compounding annual return of that investment over 20 years is 13.5%. So you're earning 13.5%, assuming your holding costs are about 25% of gross rental income. So then what I did is increased those holding costs to say 35%. And what that meant is to achieve the same return, 13.5%, instead of getting 7% compounding annual growth rate, I need 7.35%. So that is, I need about a third of 1% more growth in order to maintain the same return. It's not actually that much really, like it's not substantial. If I assume, let's make some assumptions, say these costs are going to continue to rise, maybe land tax goes up, all that sort of stuff. If my holding costs are 45% of the gross rental incomes, almost half the income's going to holding costs, I need an additional 0.3% to maintain my return, 13.5%. So therefore I need a capital growth rate of 7.65%, which is more, of course, but not as much as I would have thought it would need to be in order to cover a situation where 45% of your income is going out in expenses. So why is that the case? Well, it's really the impact of compounding capital growth. That's doing all the heavy lifting in terms of investment return. And then we get the negative gearing tax benefits. So whilst we've got higher costs, really the federal government's paying for almost half of those costs, assuming we're on the top marginal tax rate. And that sort of cushions the blow a little bit. So that's why it's not as sensitive, but I did expect it to be a lot more sensitive than it is. Now, the analysis is, however, very sensitive to interest rates, because if we're going to borrow the full cost of the purchase, then our biggest outflow, as I said, of our total outflows in total expenses, including interest is about 85 to 90% of it. It's a lion's share of the holding costs associated with investing in property. And so naturally, our return is very sensitive to interest rates. So as I said, I used a long-term average of 6.5%, which means that we earn internal rate of return of 13.5%, which is a great rate of return after tax, by the way. That's why gearing into property works. If interest rates were much higher for much longer, let's say 7.5%, instead of getting a 13.5% after tax return, my return drops to just below 12%. Still pretty healthy, still not too bad for an after tax return. If the interest rate's a lot lower than what we expect, so let's say 5.5%, my internal rate of return after tax is 15.5%. Very, very healthy, of course. So whilst property investing is sensitive to interest rates in terms of returns, it still works even if interest rates are higher for longer. So what can we learn from this analysis? Well, the key to to property investing and generating good quality after-tax returns is investing in the right property. And I can't stress that enough. Asset selection, so which property you choose to invest in, is 80 to 90% of what's going to drive your future returns. Then just having the patience to wait with it, right? So if I make a really awesome acquisition and have the patience to sit there and not do anything, just hold that property for 30 years, I will be incredibly successful and from a dollar terms perspective, make a huge amount of wealth. If I get the asset selection wrong, doesn't really matter how long I wait, my returns aren't nearly going to be as good as they should have been. And if I mess up the acquisition piece, of course, there's nothing I can do. The amount of time I wait, my returns are going to be really, really poor. So if you're going to obsess about one thing, if you're a property investor, it's buying the absolutely perfect right asset. And I discussed doing that in an episode on the 29th of March, which is called How to Buy the Highest Quality Property in Your Budget. I'll include the link in the show notes. And essentially what I conclude is that property needs to possess three attributes. Firstly, the asset's got to have a strong land value component. Building values can appreciate over time, but certainly nowhere near as much as underlying land value. That's the thing that's doing all the heavy lifting. Secondly, it needs to be in an area where there's a very tight supply and excessive demand. So an area that really will have perpetual demand over many, many decades that has those attributes. So, the amenities in the area, transport, schools, hospitals, all those sorts of things, typically very well-established blue chip locations. Thirdly, there needs to be proven performance. So the property and similar properties around it needs to have demonstrated that they have the capacity to generate good capital growth. So when you track past sales over the last 40 years, for that property that you're contemplating buying and properties around it, you can see that they've had the ability to successfully grow in the past. And they're the three attributes that you need to buy something that's investment grade. And then secondly, most recently, I've been talking about, picking which geographical markets are primed for growth. So which geographical markets have underperformed in recent history, let's say over the last 5 to 10 years, and therefore are likely to enter into a growth cycle. And if you can be strategic about it and enter into those markets, that's really how you're going to generate a really healthy level of compounding capital growth. And that's your key success factor in terms of earning double-digit returns on an after-tax basis from investing in property. So that's the key thing you need to get right. Of course, this podcast is really about holding costs. And of course, it's prudent to try and minimize holding costs as much as possible. Shop your insurance around. In fact, even better, get a good insurance broker. I use an insurance broker and he does all the shopping around for me. Keep on top of your lender in terms of making sure you've got the right interest rate discount, the highest interest rate discount. You might need to refinance every 2 or 3 years. I do that, not because I want to do it, but typically that's what's necessary to get the best deal and the best loan structure and the highest borrowing capacity. It's just about playing the game. And that's why I called my book The Rules of the Lending Game, because it really is a bit of a game of finance. Now, finally, what do you do if you've got a property with low capital growth prospects, or that in fact it's produced very low capital growth over the past number of years and certainly over the long term? Well, obviously, properties, irrespective of their growth, they cost the same to hold, right? To insure a crappy investment property probably costs the same to insure a really great one. And so the holding costs aren't probably going to be any difference. The big delta, the big kind of unknown is the capital growth rate. Well, I worked out if your capital growth rate is below 5.5%, then your after-tax return is 9.6%. I think if you're getting less than 5.5%, these holding costs are probably making that property more difficult to hang on to, which is to say you might be actually better off investing in alternative assets like a internally geared ETF, for example. That's likely to give you potentially better returns over very long periods of time than holding on to a suboptimal investment property. So for those that do have some dud assets that aren't performing, just something for you to think about that in terms of ongoing holding costs. Anyway, it's a really interesting exercise. I was surprised by the results. I thought that the holding costs would have had a greater impact on investment returns, but kind of makes sense when you really reflect and think about it. And I hope it's useful. Again, if anyone might benefit from listening to this podcast, please share it with them. And until next week, bye for now.